Hi, and welcome back to FANG Friday. This is Ross Healy, the chairman of Strategic Analysis Corporation and a portfolio management at McNichol and Associates Asset Management. Well, we've been discussing the FANG stocks now for several weeks, and one of the things that I keep saying is that if there is any acceleration on the downside, then some of these FANG stocks could be in real trouble. But that would imply that there would be an acceleration of the downside for the stock market itself. So the question is, are we bullish or bearish on the market? And the answer is yes. Well, yes what? What is it? Bullish or bearish? And the answer is that the market, from our perspective, is very, very expensive. And there are some key areas in the market which actually have been leading up until this year for the past 10 years, such as the FANG stocks, which are actually looking quite scary. Now, although price collapses in this area are not out of the question, as they have occurred with regularity, as I hope that I have showed you in some of the charts. So far, the market has been more or less kind of drifting sideways, if I like, and therefore, as the FANG stocks continue their own kind of drift lower, what we are looking for are hopefully some trading opportunities for those of you who are watching us. One of the reasons I think that the market is not moving down any faster than it is, despite the fact that there are some horrific overvaluations, is the fact that President Trump, and reluctantly, I think, dragging the Fed along with him, but President Trump is wanting to do everything that he possibly can to prevent any kind of a bear market in the stock market, because bear markets are president killers, not only stock valuation killers, but they're president killers as well. Anyway, that's why we started the FANG Friday. We wanted to show you, first of all, of course, how structural valuation analysis, which is what we call the methodology that drives our own technical fundamental analysis, how that works, and hopefully, therefore, help to make use of money as well as lower the risks in your portfolio. By the way, our own portfolio, our own model portfolio here, this is year to date in 2019, has gained, as the end of last month, 17.68% versus a total return of the Standard & Poor's Toronto Stock Exchange index of 6%, 5.88 to be precise. So using SVA has worked very well, at least for our clients. Anyway, let's now turn to the FANGs themselves, because this is FANG Friday. Okay, let's take a look at the FANG charts. And we'll start off with Amazon. What we can see here is that Amazon simply continues to drift lower and lower relative to its HB3, which is about 12 times book value. Note, when it broke the first time, that was, of course, at those lows in late December of last year. The stock was down there just momentarily before it recovered. There was a little tiny hiccup right here in June, but since really early August, the stock has continued to drift and drift lower relative to its HB3. And note as well that the fair market value has slowed down a little bit from here. Well, here's Facebook, and we've had a sort of an interesting time with Facebook. Early in the year, the stock broke out, and over its MSG price, that's 5.5 times book value. And of course, like any good technical breakout, you tend to get a breakout and then a pullback. Now, for a brief heart-stopping moment here, the stock actually cut through rather sharply. However, it did not stay there for very long and quickly pulled itself back on side. So we had kept Facebook in our FANG portfolio all the way along. However, this last break here through the MSG is kind of the straw that broke the camel's back. And we suspect that the stock heads lower, perhaps as low as its LSG price, although, of course, as a long-time listeners to FANG Friday know, we would really love to see the stock down here at its super growth price. That is a very, very powerful support level. Alphabet, well, there's not much to say about Alphabet. The 10-year chart very clearly shows the range that the stock trades within. Its LSG price, which is 4.5 times book value, and occasionally getting down to its mid-growth price, but mostly bottoming in and around its super growth price, which is a very, very critical breakpoint within the SVA analysis work, which also happens to roughly coincide with its fair market value. So when we started FANG Friday, the stock was already up at the extreme end of its valuation range, and we had been waiting for the stock to come down and give us a clear shot at buying it at a reasonable price, and perhaps its fair market value as well. Here is Netflix, and Netflix has an interesting kind of a pattern here. We've had, from its peak, and this is the absolute peak in the stock, it had a 1, 2, 3 breakpoint move down, and then a 2 breakpoint recovery. Could not get through the HB5. That's about 16 times book value, and now it's had a 1, 2, maybe a 3 times 3 breakpoint downwards move. Right now, we are prepared to be both cautious and patient for that to occur. This kind of 3 down and 2 up, or 2 down and 1 up kind of pattern, a walking downstairs pattern, is very common in stocks, particularly growth stocks, in which investors are kind of reluctant, as it were, to let go of the dream that these things are not going to continue to be scintillating performers. One of the companies that we wanted to look at, of course, is really, I guess, the first major announced competitor to Netflix in terms of streaming entertainment is Walt Disney, and of course they withdrew the Disney productions from all of Netflix streaming. However, it does not appear to have done Walt Disney very much good. The stock for some while has kind of traded either side of its mid-growth price, which is about 2.5 times book value. But in the meantime, the earnings and the fair market value were sort of oozing lower, and of late they had been moving lower at an increasing rate of speed, thereby fully justifying the decline in the stock price. Indeed, looking back at Walt Disney for all of the recorded history that we have of the company, the fair market value has been in and around about the peak valuation for that stock. Apple, well, what can we say about Apple? It continues to trade at an extreme end of its 10-year valuation range, which is in and about its fair market value, and in this case, a little bit above there. For the past 10 years, however, that has tended to pull the stock down, and indeed pull the stock down to a discount to that level. So as the stock is moving higher and higher, somewhat confounding our expectations for it, nonetheless, that doesn't mean that things are about to change for this company. They've had 2 miserable quarters already this year, and we are really curious to see what happens when they report next. Turning to NVIDIA, well, we've already seen a huge decline in the stock, a 1, 2, 3, 4 breakpoint decline, and it hit dead on its bubble price. That's 7.4 times book value. Following that, it had a 2 breakpoint bounce, actually set all the way back to its bubble price, and since that time has been hanging just in around its HB1 price. That's about 10 times its book value. Now, there has been a slowdown, a write-down of their earnings outlook, but lately it's picked up, and that's on account of the fact, I think, that people are still hoping that there is life after death for Bitcoin. If there is not, we suspect that there are going to be lower prices lying ahead. Finally, we come to Microsoft, and as we have pointed out before, the very long-term history of Microsoft points out that at its HB1, that's about 10 times book value, that has tended to be absolutely it for the valuation of this company. It hit there last year, and it's been scraping along that level for this year, but has been able to break out, and now we're beginning to see a gap appear between its fair market value and its current price. We still expect that this stock is going to be pulling back, and therefore we are unwilling to hold or own this company in our portfolios. Anyway, that has been the FANG Friday review for this week. I'm Ross Healy. I'm the chairman of Strategic Analysis Corporation, and I'm a portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next Friday.